Hi, welcome back. We have chapter 2 that I would like to talk a little bit with you about, specifically how you get the cash flow from revenues and operating revenues and so on. And so I'll be quick and I'll just point you out to a couple of things. I know in our reading, we don't have this in module 1. However, we're going to do it a little bit later, but I think it's sufficiently important because we're talking about cash flows and about valuating companies and so on. I think it's important to have take care of a couple of things right here before we go forward. So in general, we're just going to touch base on a couple of other things. Like, we have an income statement and a balance sheet here, which we're going to work with as part of some given numbers that we'll use to derive cash flow. We also have a cash flow statement, and you probably want to ask, why don't we use that? Well, it's because we have many other things that we consider in normal cash flows that we don't really want to consider in computations from revenues. And the second thing is as we begin to do forecasting of revenues and forecasting of project revenues from capital budgeting becomes a little bit more difficult. So we have developed some shortcut methods of coming up with free cash flow, which is acceptable and very reasonable in doing valuation. We gain nothing by doing a heck of a lot more work. So what we're going to talk about here, although it shows you a little bit of 3-step, actually a nice 5-step process that we go through to try to figure this out. Now, I want you to pay a little bit of attention to this 2-year income statement, 2015 and 16, and we'll do the same thing for the balance sheet. I'll ask you a few questions here that you can go through, and it might be helpful to take a look at that and answer and see before you go forward that we understand what's happening in this cash flow on the balance sheet for this company. Now, there's your second part of the balance sheet, the liability and equity section. And then, of course, we talk a little bit about the cash flow. The statement of cash flows, you know, has 3 parts. One is cash provided by operations, and of course, cash from investing activities and cash from financing activities. Now, to give you some summaries and to go through these things, what I want to show you is we have this model that will give you step 1 here, then step 2, 3, 4, and 5. And to get you familiar with what these numbers really mean and how they, or where we get them from and how we compare them and so on. We're going to use the income statement and the balance sheet that we have provided, simple as it is, but it does serve the purpose. We're going to walk these things through the 5-step process. And in the end, we're going to come up with the free cash flow. And it is instructive and very good for you to actually do this. And here is so net operating profit after taxes, so we compute those. And then we go through this thing and we compute all the other things. And so we come up with the free cash flow. Now, I need to say to you that there are actually 2 types of cash flow, free cash flow. One is free cash flow to the firm, FCFF, and free cash flow to equity, FCFE. And one to equity doesn't include interest payments. So once we subtract interest payments, we get the free cash flow to equity, and this goes on to be used to value equity and value shares of stock. So here we go through the whole thing and we talk a little bit about it here. In this one, you can see we're talking about NOPAT per sales. That is generally what it takes to generate $1 of sales. And you can see here we have two values. Operating profit, the amount of operating profit generated for $1 of sale fell between 15 and 16. You can see operating profitability. Okay, they have a couple more of these kinds of numbers. Like this one here, NOPAT over total operating capital. And so what operating capital does it take to give you your, what does $1 of operating capital give you? Here in this case, capital requirement, total operating capital over sales. We see that it takes, for every $1 of sales, we have 38.7 cents, and in 16 and in 15, 19.5. It says the capital requirement, the amount of operating capital required to generate $1 of sales went up between 15 and 16, which means capital utilization worsened. These kinds of things are good to kind of understand where the company is. So we go forward, and you can see that they use this very nicely to come up with the answer, come up with what we're looking for, which is free cash flow. Now, this thing called economic value added is very important because the weighted average cost of capital is the percentage, sort of like cost of capital is a percentage, sort of like an interest rate, and is used to discount our cash flows to give us the value of the company or the value of equity. One thing to note here is the economic value added. And that is, I noticed that some of you had talked about profitability and so on, but that's not really what we're after. We need to be making more. We need to be generating more profitability than our cost of capital. So, if our weighted average cost of capital is 8% or so, and we're generating return on investment or net margins, stuff like this at 5 or 6%, we're not creating value. We're not creating economic value. Here you see he uses NOPAT times the weighted average cost of capital for total capital to see what we come up with. So basically, we're trying to make sure that we're earning at least our cost of capital. And if we are, then we have economic value added. And that's what he's doing here. So he goes through this computation. It's good to walk that through. And you can see how we come up with earnings per share and dividends per share and so on. Market value as opposed to book value. Book value is what we have on the books and based on our investments, our assets, and so on. We can come up with book value of everything. That's what's in the book. But market value is different because market value has factored in expectations of future cash flows, future action taken by the CEO, and so on. And we add those things, and analysts usually recast income statement and balance sheet and think about what's going to happen, add and factor all of those things in, and come up with their own cash flow, which is later used to value the company. And this is how they generally would predict what a future stock price might look like. So here they're talking about assume market value of debt is equal to book value. That's normally what happens. Market value and book value of equity are two different things. Debt doesn't change because debtors don't participate in the growth of the company. They loan us money, we take the money, we pay them an interest, and we pay them the principal at a later time, but they don't participate in the growth or the loss of the company, typically they would have to be paid. Corporate tax rate, and talk about your tax base. So here we have, some of these tax rates, and then we have rate on the amount. And most of our corporations, as they've been talking about, is we pay a lot of taxes, and here it shows above 18.3 million and up 35%. So they have these rates on a marginal basis or on a step-by-step basis. And then we have these numbers that go above that. We pay this 35 or 39 or whatever it is. Here they give you an example of what that looks like, and they compute your taxes. And they give you a little bit more here about taxes. But the most important thing is that, using a 5-step process to figure out free cash flow to the firm, given a certain income statement and a balance sheet. And go through this and pay attention to it, because at some point we're going to have to take a look at the income statement and balance sheet in the 10K, and derive some cash flow and try to figure out value of the company. And the kind of computation that they ask you to do in some of the exercises, not so meaningful. We used to do it a little bit differently, and it was more difficult, and people had to go through and figure out what was happening using the actual 10K and the actual income statement and balance sheet. So it's a little bit easier, and you can still do it, but at some point it's good to take a look at Home Depot's actual numbers from the 10K and then work these things out and see if you can figure it out by yourself. Okay, and they go through and they compute and do some other things with taxes and so on. And I want to go through that. You can take a look at it. But generally, that's something that I really want you to take a look at and try and see if you can go through it and understand it. Once you do, then figuring out cash flow from a project or after forecasting shouldn't be that difficult. All right, we'll see you later. Thank you for watching.